family office out on Sand Hill Road in Silicon Valley for 20 years. Was an active angel 20 years ago out there. The first sort of the granddaddy of the angel group, the Band of Angels, was founded in my office. I got active, helped my clients do better angel investing, and in working with them, I found these tax laws and some of the other instruments that we're going to talk about. The goal of this is not to make you a tax expert, by the way. It's for you to understand how understanding these tax laws can make you look smart with investors that will accelerate your funding, and to give you some very specific strategies on how to use this language without being experts, so it can actually make you stand out and look more credible and more serious in the eyes of the potential investors you're going to be knocking on their doors. Okay? That's the whole goal here. I'm not trying to make you an expert. QSB has been around since 1958, so these are not new tax laws. Okay? QSB 1202 has been around in 93 and was last updated December of 2015, December 15th of 2015. Program-led investments is a way to how to find money from foundations. Great big piles of money out there that are already showing they care about or potentially care about what you're trying to solve. And they're donating money to nonprofits that are raising awareness around the causes. Why not invest in the solutions to the problems themselves? So I'm going to show you the language about how you can approach a new pile of money. It's not an angel group. It's not a venture capital firm. It's actually that money out there that's patient, that's long-term, that they're already giving money away and they're losing it as soon as they write that check and give it to a foundation. They can invest in you and have a better financial outcome no matter what happens to your business. And then I am going to pitch you as to why, damn it, you should be transparent. QSB 1244, when it was passed in 1958 under the Small Business Investment Company Act, it literally was passed to stimulate investors into this new asset class called venture capital. The law only applies to individual investors. Okay, it only applies to individual investors. Now, if any of you are pitching VCs, this applies to the VCs because they probably have investors in their fund that are individual investors. So it's still relevant regardless of whether you're pitching a VC or an individual investor. Okay? You as companies have to be a C Corp. Now, I know there's a lot of debate over whether you should be an LLC or a C Corp. There really isn't a debate. The people that are still championing LLCs don't know about this law. I promise you that. Okay? I've got an accountant with Anderson Tax in Houston that's my expert nationally on this. He has run the math. It makes more sense to be a C Corp. If you go to Y Combinator, what do they tell you? You have to be a Delaware C to get in there. Wilson Sonsini has video training on how to start a company. They say you should be a C Corp. The people that champion LLCs don't know about these laws. They're showing their ignorance. I'm dead serious. And I'll talk to anybody that counsels you on that.
That's for companies that are raising equity.
That's correct.
Okay.
That's correct. Now, there are some business models that are best suited for an LLC, and there's no doubt about that. But that's not the typical startup. If you're building a company to grow the business, it's not going to be a lifestyle business and a cash cow where you're going to quickly distribute profits. Those are typically service businesses.
We're an LLC right now, but we know we need to convert as we go into this raise.
Yes.
Any implications for us if we're converting from one to the other as you're speaking about that?
You don't want to raise money until you've converted.
Okay.
Convert and say, we are a C Corp, and as such, what I'm going to educate you on applies.
Even though it looks like we may take losses for the next 6 months.
That doesn't matter.
Okay.
That doesn't matter. Okay? Your operating status is irrelevant to these tax laws applying to the investors. Okay?
And it's only the first million of outside.
For Section 1244, it only covers the first $1 million. And what it says is, that if you're going out and raising the first $1 million of outside capital, and those investors, which are typically the case individuals, you're not going to get institutional money for your first $1 million. Okay? Their investment is de-risked, meaning that you're a lower risk investment for them because of this tax law and simple awareness of it. Because what it says is if you fight the fight you're wanting to fight here, you're going to try and build a business to solve this problem they clearly care about. Otherwise, they wouldn't be talking to you. And you fail. For whatever reason. Number one reason startups fail is just timing. It's just timing. Then it's product market fit, then it's capital, and then it's basic, broadly defined bad execution. But timing's number one. Nobody can predict timing. So you can say, look at Mr. Investor, our investment, you clearly care about what we're doing. We're going to fight this fight because this problem needs to be solved, whatever the hell your businesses are. And by the way, you can invest in us and it's a better financial transaction if you gave the same money to charity. Because it's the same motivation as to why they write a check to charity. They care about that cause and they're losing that money right away. But they care. Okay? 1244 says if you invest in me and my company fails, you can take a better tax deduction on your tax return than if you gave the same money to charity. And by the way, we're going to fight this fight, and with your help, we can have an exit. We're going to make money off of this. And I'll talk about the next law where they're really going to get excited. But if we don't, if we fight this fight and we don't make it, it's still a better financial outcome for you than if you gave the same money to charity. Now that language, they're going to go, what do you mean? Well, at Mass Challenge, they taught us about this tax law, and here's information on it. You don't need to be the expert, folks. You can either send them to me, or I can give the name of the accountant, and they go talk to the accountant. Now, I've done the presentation on these tax laws to very sophisticated people. There's a family office out in Silicon Valley named My CFO. They handle wealthy people's money. They're investment advisors. Their minimum account's at $100 million. Look them up. 18 of their in-house staff CPAs did not know about these laws. So these things are real opportunities to really show you guys have done your homework and you're thinking about those investors first. You're not just selling your passion and how much money you're going to make them. You're de-risking it for them. And you're thinking about them and how they write other checks as well. So they get excited, and when they go tell their spouse, hey, I invested in this startup, and even if it fails, we get a better outcome than we gave to the university. And I'm tired of giving money to UT anyway. But guess what they're going to try and solve? That's the conversation they get to have when you educate them on this. And it applies.
Those conversations going well. So for instance, we're in the med tech space and we're developing something that can help in oncology surgeries.
Oh, Jesus. Do you want to profit from solving cancer, or do you want to give money to Cancer Society?
Okay.
Which one you want?
Yeah, Bianca's in the same boat.
Yeah.
Yeah, okay.
Do you want to make money by solving the problem, or do you want to give yet another check to the Cancer
But
Society?
have you seen people yet use those arguments successfully? Okay.
This shit works. Okay? That's why I gave you my background. Yeah, I've been doing this long. I was a philanthropy consultant as well for 20 years. Yeah, this is my background. This shit works. This is how adult investors, the smart money, wants to be communicated to. If you're just selling your passion and bludgeoning them with your passion about how serious this problem is, they already know the problem's serious. They wouldn't be talking to you. So don't waste their time. Say, look, I'm going to de-risk it for you. Heads you win, tails you win. That's a smart conversation. Okay? Now again, you don't need to memorize all this stuff. I've got it all written down if you want a handout. But you just need to understand how to message it properly. And by the way, wealthy people, last year they gave away over $92 billion to nonprofits in large donations. 3 times more than they invested in startups. And they knew when they wrote the check it was gone. So don't think that they're unwilling to write checks that where they have no chance of getting that money back. It's just the opposite. If they care, they're more than willing to. And you get to make this a smart transaction by investing in you, just by knowledge of this tax law. Questions? This is really important stuff. Who's raised any money out there? How much have you all raised?
Recently at 500,000.
You've raised 500
Yeah.
already?
Not yet, nothing.
Oh yeah, you haven't raised money yet. How about you?
300,000, and
So-
it was through charitable.
So you got a nonprofit. Was it a grant or did they do an MRI?
No. He put it in a charitable trust, and then was written to a for-profit company of ourselves.
So he's doing what's called a mission-related investment. I'll talk about that. How about you?
650 seed round from a VC in Greece.
A VC in Greece,
I
okay.
have the company in Greece.
This only applies to U.S. taxpayers.
Yeah, we'll come here actually.
Yeah, so your next $350,000 you raised qualifies for this. So if you go and raise now, you're going to go raise, let's say, $1.5 million. What this will allow you to do is to say, okay, the first 350 gets this, so hurry up. You get to stimulate and create a sense of urgency. And if any of you are raising a $2 million round, you can stimulate and get people to rush to be the first million, which is always the hardest.
Mm-hmm.
Right? The law allows for you to segregate who qualifies. If you're raising $2 million, you can separate the first million and give all that benefit to them. Or if you get 2 million all at once from a whole bunch of investors, you can actually, all of them would get this, but it would only apply to half their investment. So you can prorate it. It's either isolate or prorate. Either one is available to you.
Does founder's equity offset that?
No. The next one does, though. The next one gets even sexier. Okay. So this is really cool stuff. The sole message is, look at, if we're raising whatever you're raising, but the next dollar, these dollars are de-risked. Because whenever they're doing due diligence means de-risking, folks. Help them de-risk it efficiently. Okay? Because then, once they're convinced, you're an adult. You understand this is a risky venture. You're not just selling the dream. You're an adult. You're asking an adult to make an adult decision. You're giving this adult the right information to make an adult decision. Once that's clear, you've educated them on something they've never heard before from any other startup. Holy crap, your credibility just went up. Now they get to talk about the business. And now it gets really fun. You can talk about your execution plan and why you are a team that's unique to solve this problem they care about. Okay? Because you need to get any investor you need to answer three things. Why should they care about what you're working on? Why you and your team, and why now? That's it. Well, you're solving two of these real quickly by just showing you've done your homework. Okay? The other tax law is Section 1202. That's been around since 93 and was updated in December of 15. And that says, okay, what if you actually fight the good fight and you have an exit? This says profits are 100% tax-free for those same investors. Profits are 100% tax-free for the first $10 million or 10 times each investor's cost basis, whichever is greater. So if somebody puts in 50 grand in your company and you crush it, and they get $12 million in profits from their interest, their $50,000 investment, 10 of those $12 million are tax-free. Holy shit. If they put in $2 million in your company, they get $20 million of profits before they ever have to worry about taxes. 10 times their cost basis. Holy crap, yeah.
Does convertibles fund the 5-year investment?
This is where the details are. The law says that when they invest, they have to invest in an equity-like instrument. An equity-like. Now, I've talked to a lot of lawyers and accountants on that language, and that's a very broad definition. Equity-like means it can't be pure debt. Okay? They have to have equity risk or equity exposure. Convertible preferred, convertible notes, qualify. Okay?
And you alter the conversion event within 5 years. Doesn't matter.
It doesn't matter.
Okay, that's what I'm like.
Okay? That's the sole language. It's very broad. In fact, Section 1244 hasn't been touched as a tax code since 1978. I've been lobbying for 2 years to get that modernized because the language under 1244 doesn't take into account the modern entrepreneurial journey and instruments. It hasn't even been updated since 1978 because nobody knows about it. And you'll see that updated, you'll see that modernized in the next year to 18 months because I've got people in Washington work on it and all sorts of stuff. Okay, but this is another, so the first conversation is, look, if you're willing to be that first $1 million in the U.S. taxpayer, then it's de-risked for you. Now this is for funding rounds much later than the first $1 million, by the way. So this could be your A round, B round, C round transactions. Because at the time of investment, you as a company can't have more than $50 million of net assets on your balance sheet. Every other funding round that's in an equity-like instrument, a C Corp startup, qualifies. So after the funding round is closed, as long as you don't have more than $50 million of net assets, which includes the cash from the funding round, then those investors that have invested in you get the opportunity to have their profits tax-free. It takes 5 years. So when they invest, whether it's your early round or a later round, it still has to be 5 years from the time they invest for this to qualify. So what you're doing is you're literally saying, look, be patient. We want this to take 5 years. All these VCs are trying to get their 2 and 20 triggered, and they've got perverse incentives from the startup journey. Patient money, you're rewarding patient money. It also makes negotiations in a transaction easier. Because you can soften the price you're willing to sell it at if you're past that 5-year window. You can give a good deal to the buyers and still have more after-tax profits stuck in the investor's pocket. And by the way, this does apply to founder shares.
Mm-hmm.
This applies to founder shares. 1244 does not, this does. I can't tell you how many founders don't know about this.
And
You
the
should-
clock starts ticking, in my case, once that
When you convert.
conversion, or does it?
When you convert.
It's
Now,
only when I
now,
convert.
now the good news is, and this is getting in the weeds on taxes, but when you convert from an LLC to a C Corp, if you do it right, then what happens is the C Corp gets these assets contributed. The conversion process, you're actually contributing the assets. And the owners of those assets, the LLC and the managing member, have a cost basis. Okay? That either gets, if it's done right, your cost basis of the C Corp shares that you're receiving by contributing these LLC assets, it's a stepped up basis.
Okay. Sweet.
Yeah. So you got to get that right. Well, if you get it right, next thing you know, you could, as an entrepreneur, sell your business, pay no taxes on the gains. Holy crap. And that's the same thing with all your individual investors. And whether they invested in a venture fund or directly out of their own pocket, it doesn't matter, because a venture fund is an LLC and the tax treatment passes through the individual investor. Did you have a question?
Yes.
Yes, ma'am.
So we started as a Texas LLC a while ago. We got a phase 1 SGTR grant from the NSF, which required me to do payroll, so I had to, from the IRS perspective, I'm taxed as a C Corp. So does that mean that my clock has already started?
That's a great question. I don't know the answer.
Okay.
I've got a CPA that can answer it for you. That's ready to take any of these sorts of specific calls. He's with Anderson Tax. He has represented taxpayers in audits with the IRS when they've taken both 1244 and 1202. He is the person that has more knowledge than I do on it.
Great. Thank you.
Okay, so I'll be happy to provide that. Yeah, Jason Graham's his name, Anderson Tax, but I can give you his email and phone number. He'll take any phone calls.
Thank you.
So messaging this, folks, is really important, especially if you're working on something that people are going to care about. Heads, you win, Mr. or Mrs. Investor, because even if we fail, you get to deduct against, especially if you're raising that first $1 million. Heads, you win. Tails, you really win. You get to profit and potentially have tax-free profits on something you cared about. Holy crap. Now they're excited. So tell me what you're doing. Now you get to talk. Now your passion gets to come out. But you've de-risked it for them first. You've ticked all those boxes. So all those other due diligence-y questions really melt away. They don't have to ask questions. They probably didn't even know what to ask. You've de-risked it by existing tax law. Okay, they don't have to be experts in your business. They get to be excited about what you're doing. Okay? Make sense? Is it worth coming? Already, good. I'm glad. He wasn't going to come, but I convinced him to come. Okay? Now, what happens if an investor invests in a C Corp startup and it qualifies for 1202 treatment and there's an exit, but happens with inside the 5-year window? The law allows for what's called a 1045 exchange, which means those investors, they didn't have the luxury of waiting 5 years to the tax-free profit window to open. They can take their proceeds from that sale and reinvest it in other startups pre-tax. They don't have to pay taxes on those gains. They can roll it over and reinvest in other startups pre-tax. And any of these new startups they invest in, if their first company lasted 3 years and they got their money, any of the new companies they invest in only have to last 2 years, and you've now had a 5-year holding period, and you're at the tax-free window. Okay? Now, a lot of investors don't know you can do a 1045 exchange.
So you're saying the time in on the first company converts to the subsequent?
You carry those investors carry forward their cost basis and holding window. Yes.
Sweet.
Yeah. So how can you use that information? You go look on Crunchbase for companies doing something similar that had exits, see who the individual investors are, and go call them. Say, oh, by the way, you can roll over some of your money, some of your profits into us pre-tax, by the way. In real estate, this is called a 1031 exchange. Anybody ever heard that phrase, 1031? It's a very common practice in the real estate world. But 1045 is even easier to do than a real estate 1031 exchange. In life insurance, it's called 1035. There's lots of codes that allow for you to avoid taxes if you roll over profits into a like-kind asset. What's neat about this is that in real estate, I like whiteboards. Oh, here we go. In real estate, if you make $10 million and you want to roll it over, you've got to roll it all 10 million into one property. Real estate brokers love exchange money because there's a 180-day window to roll it over pre-tax. So people that sell a building, they go call brokers and say, I got exchange money, go find me something. Their due diligence gets softened because they want to avoid the taxes. Okay? And they've got to roll it all over into one piece of property. In a 1045 exchange, this is a 1031. In a 1045, if they put in, let's say $100,000 in the company, and now that's worth $1 million, okay? They can actually take $300,000 out. The company got taken over in 3 years. They can take their cost basis plus book a profit of $200,000. They're a hero. Brag to their wife, husband, go on a vacation, spend some money, and they can roll over the $700,000. That's called house money, by the way, in poker terms. And they only have 60 days to do it. They got to get their ass lined up. You go call them. I track Crunchbase every day for this exact issue. Say, hey, did you know you can roll that over pre-tax? And they can do it in a portfolio of companies. What if they did it in 15 of these mass challenge companies? Sprinkle that $700,000 across 15, any of you, or several of you, then have exits. They win. And it's house money. They're now compounding. They've booked a profit. 1045 is even easier in real estate than a 1031. Now, nobody knows about that. The other challenge is, nobody utilizes it because of that 60-day window. It's part of what Angel Span solves for you. If you are using Angel Span, you're communicating to those investors ahead of time. Okay? Because they have to be able to make their decision quickly. They have to have already bought into what you're doing and care about what you're doing. That's part of what Angel Span solves for as well. Because they only have 60 days to make that decision.
Hey Joe, for is 1045 exchange applicable to any of the dollars that may be taxable if you go above the 10x cost basis? Like, can you throw any of that to the 1045 exchange?
Oh, absolutely.
So let's say that my cost basis wasn't high enough and suddenly I'm making like $3 million of what I've just made is now taxable off of that first bullet.
Yes.
You're saying that we could use this to flip over. Okay.
Yeah, let's say for sake of example, they put $1 million and they get 12 million.
Yeah.
Yeah, that extra 2 that's not tax free can do a 1045.
Okay.
Yeah. There's also, I got a long white paper from some accountants and lawyers on this. They could get really creative and put some of those shares in their kids' accounts. And now all of a sudden that 10 million is 30 million because they just put those shares in 3 kids' accounts. There's lots of things you can do to get really creative to avoid taxes.
So does he get taxed for the $300,000 he pulled out?
Of course.
Okay.
Yeah. But that's a choice.
Yeah.
You book a profit. It's like, bird in the hand, great, feel good about it. I got a 3x on my original investment. Actually, yeah, it's a 3x. So now there's no downside. They care far less about the return on this. So what does that do? It lowers the due diligence hurdles. They're not going to bust your balls on all that sort of crap you hear. They say, great, it's exchange money. Okay?
They just care it's done in 60 days.
Huh?
And they care it's done in 60 days.
They got to get it done in 60 days. They don't get to slow play you, folks. What do investors do? They hang around the rim and they raise the bar. Well, if you can get a little more, all right, go ahead and pay taxes. That's good for you. All right? This is another source of well-intended patient capital that's already tax advantaged. Anybody ever heard of a family foundation? Community foundation? There's one here in Austin. A foundation is where a legal entity is formed that is a nonprofit organization. Okay, this is an individual family foundation, a community foundation. And a foundation is a 501c3. It's a nonprofit. When individuals put money in that foundation, let's say they put $1 million in a foundation, they get about a $300,000 tax deduction the year they put it in. They get to take that 501c3 tax deduction. Even though they've given it to nothing but a legal shell. There's no nonprofit that's ever gotten any of that $1 million. They gave it to this foundation that then has to give 5% per year away to 501c3. And while they're in here, they file a 990 tax return to show that they are giving at least 5% away. That's the basic construct of a foundation. While the money is in here, because the government gave them this immediate benefit for these future donations, this money now has to be managed as if it's like a pension plan. It's an institutional puddle of money. Prudent man rule, fiduciary responsibilities all apply to the trustees that are managing this pile of money. Except when there are opportunities to invest some of this money in otherwise risky ventures that would violate their fiduciary responsibilities as trustees. But those startups look a lot like these nonprofits, but they're just for-profit business models. So if part of the mission of this foundation was to support cancer awareness, why not invest some of these dollars in cancer cures? Holy crap.
Is that part of the 5% distribution, or
No,
is that internal of the?
It's an internal corpus.
Even though it could be high risk and outside of the thesis of the fund.
That's
Why is that? I don't get it.
It's called program-related investing or mission-related investing.
Do
I've
they-
got a long white paper from the Rockefeller Foundation.
I'd love to see that.
So when you're
Because I was just on to the Humana Foundation, they said, oh, we don't really do this.
right,
Because I was trying to convince them to look at impact investing.
like the tax laws, a lot of foundations don't understand MRIs and PRIs. You'd be shocked.
Hmm.
Yep, I'm running out of power real quick. I thought that was coming. Anybody got a Dell plug? Dell power cord? Do you? Thank you. Yeah, I think that'll work. Thank you. I think mine's the bigger one.
Yeah.
This is what mine is.
Yeah, I think that's the line right there, yeah. Yeah, that's it. This is another great way to unlock capital that's, again, well-intended, patient capital, cares about what you're working on. They're called mission-related investments. So when you go unpack, I was going through this exercise earlier, if you have the cancer issues, or you've got something where you're solving something meaningful, you can go find the industry foundation and go look at, we just did this, didn't we?
Yeah.
This is epilepsy. We went to the Epilepsy Foundation, and in their annual report lists their major donors who are already writing checks because they show they care about that cause.
That's really.
A, you can go call them and say, by the way, we qualify for Section 1244, so even if we fail, you get a better deduction than if you gave money to the Epilepsy Foundation. And with your own family foundation, you can do an MRI in us as well. Holy crap.
Now, your bullet point said, or the last line says, impact investing. Do you have to qualify under any regulatory?
Impact is in the eye of the beholder.
Okay, that's all I wanted to make sure, that it didn't have a special.
There's a good video on this. Jean Case, Steve Case's wife, is sort of driving their foundation activities in the impact space. She did a presentation to Milken a while back. It's on YouTube. And it was on impact investing. And she said, first we need to level set. What is an impact company? And her definition is now fairly universally accepted. Is that company committed to transparency? What does Angel Spend solve, by the way, folks? Are they committed to measurement? And do they intend to have an impact? Do they intend to have an impact? Very nebulous definition. Well, a guy raised his hand. He says, what do you mean by that? I'm what looks like a traditional startup, but I chose to do it in Baltimore because I wanted the wealth creation, the jobs creation to be in this blighted city called Baltimore. Is that an impact? Am I an impact company? And she said, for the people of Baltimore, you are. And that's a fact. That's called place-based impact investing. The very reason you are impact is because you're doing it in the city they care about. This is one of the hottest trends in community foundations.
Now, let's say that they have a pool of $100 million there in the middle.
Mm-hmm.
But what do you see as a standard that they'll place towards these types of high-risk investments?
It
Is
really
there
do-
a rule of thumb? Or
No, there's not. This whole movement, impact space for foundations, is new. Now, I've got lots of examples of cities and community foundations doing it. The Heron Foundation, H-E-R-O-N, converted 100% of their foundation to impact, both public and private securities. 100%. They're the ones that are most out front. They're the ones that are coaching the Rockefeller Foundation, who, by the way, just got rid of all carbon-based investments. They invented the industry.
Yeah.
Now they're out of it. They've converted 100% out of it. So this is happening from the real thought leaders. The Ford Foundation got a new person running it. They've just put $1 billion in the work. That's our starter kit. So this is happening, okay? And it's happening in small community foundations. I say regional community foundations. Depends on who's running it. Is it the old guard or the new guard? Old guard is beholden to the old models, and they don't want to do anything new and creative and innovative, and that's fine. It's easy to spot who that looks like. Okay, you just got to do a little bit of digging. That's what I love doing. So that's your solution. Go find your communities. I mean, you got a great effect. You got Greek. You're Greek, right?
Yeah.
Shit. A lot of Greeks want to support Greeks, right? I trust Angelos to talk to you.
Yeah,
Yeah.
I know those.
No, it's a classic. International Studies is a client of ours, right?
Yeah.
But this is absolutely, when you find people that care about what you're doing, then there's all these tools to de-risk it and stimulate their investment and support. Now contrast that with going and pitching an angel group or a VC. Oh my God. Right? They're going to ask questions. They don't even really use that data. They're using those questions to avoid making a decision. They don't want to say no because they don't want to miss something. But they certainly don't want to say yes. That's all they do, is avoid making a decision until they see somebody else validate, and then they want to rush in and be on the cap table. We're saying, screw them. Let's go find the right money for you. Now, this is where it becomes a shameless plug for what Angel Spend does, but this is not me saying this, folks. We're just simply solving a problem that's been well recognized. Entrepreneurs, you guys are all shitty at communicating. That's a fact. You all want to put out newsletters. You all want to put out things that just talks about the cool shit you're doing. That's not how responsible money wants to be communicated to. See how I deal with that. This is from Y Combinator. There is a link between entrepreneurs that embrace transparency, meaning voluntarily communicate, not in a puff piece, not in a newsletter, not in the chest thumping, everything's great, but saying, look, we're fighting a worthy fight, and this is a quixotic journey, and shit's going well, and some stuff's going bad. That's how adults communicate. Now, entrepreneurs are fearful of it, they don't know how to do it, but there is a statistical link. We've got a research report that shows entrepreneurs that embrace transparency, voluntarily communicate, good and bad stuff, actually execute better, because it speaks to their maturity. It speaks to their willingness to solicit help. It's evidence you're coachable. You don't have all the answers. Now, how to do that is hard. That's what Angel Span does. But it's important, because those foundations, I was a philanthropy consultant. I saw how these philanthropies were really good at soliciting my clients, communicating with them before they were going to ask for money for the next capital campaign of the wing of the hospital or the university building or whatever the hell it was they were going to raise money for. They would communicate to them ahead of time to keep them engaged, keep them caring about the cause. The inevitability of the ask is going to happen. These people aren't stupid. They don't want to be disrespected. They don't want to be taken for granted. Those are the two principal things that I hear time and time and time and time again from this well-intended pool of money. They don't like to be taken for granted. They don't like to be disrespected. Because their purpose for investing is honorable. It's for the right reasons. And entrepreneurs don't get that, you're mucking up. This is some of the statistics from the research report. 34% communicate quarterly to their investors. Every term sheet has what's called information rights. You're required to avail your financials. Yet about a third of the entrepreneurs do. You're choosing to violate a portion of your legal document called your term sheet. You took their money and now you're saying, never mind. Are you kidding me? That's disrespect. That's absurd. I saw this time again as an angel investor, and when my clients, I introduced startups to my clients that wanted to invest in this worthy entrepreneurial cause. And they disrespected my clients. It pissed me off. And then entrepreneurs complain it's hard to find the right money. Well, guess what? Oftentimes it's your own damn fault. They also recognize that the entrepreneurs that communicate actually execute better. They're also far more willing to do follow-on funding, yada, yada, yada. Okay, good shit happens when you communicate, bad shit happens when you don't. It's that simple. In summary, all right, Tax laws can help you facilitate funding to the right money. Just a little bit of knowledge, you don't have to be experts. Just understand how de-risking it makes it easier for them to say yes. Okay, except you're not de-risking using all those stupid little metrics that these inexperienced angels or VCs want to throw at you to avoid making a decision. You're actually giving them facts that they didn't even know. They didn't even know to ask about this. So you're now the smartest person in the room in the journey of de-risking your transaction for them. Transparency is evidence of a better performing, more mature entrepreneur. Don't be the other kind. If you are, you're shooting yourself in the foot. I pity your investors. Just make it easy for them to invest in. Is any of this, aside from the tax laws and the PRS, new? Have you been told why communication is important? Do you really understand it? I mean, it's really critical, folks.
Takes time to build trust. People don't invest if they don't trust you.
Yeah, it's that simple. It's common sense. Years ago, out of college, I went to work for a brokerage firm that's been absorbed and now part of, I think, Morgan Stanley. It was E.F. Hutton, long-time firm, long-time absorbed. And when I went back to training in New York, they said the best way to be a good broker is to become a client. Right? Invest your own money in the markets. Invest in the very things you're telling other people about. Treat them how you want to be treated. Well, if any angel investor that's starting a company, they sign up with us and they don't even ask what the price is because they've invested in startups and they're pissed off because they haven't been communicated to. And they're value-add investors. They want to help, and they don't get communicated to. So they're the quickest ones because they don't want to be that person. You know, if you treat your investors as if you were an investor, it's how you would want to be treated. And the other thing that we're creating is a path so that investors can actually be better investors. Investors shouldn't invest in 2 or 3 angel deals and sit back and wait 5 to 7 years to see if anything happens, which is what typically happens in angel groups. They should invest a little bit in a lot of companies. And if you're going to do it right as an investor, how do you monitor a lot of companies? You want consistent reporting, looking all the same from all of them. You know, if any of you have ever built your own stock portfolio in the public markets, didn't buy an ETF, you actually bought stocks, what'd you do? You went to Yahoo Finance, you went to Google, wherever you chose to get information on the companies themselves. And every one of those reports, whether it was Google, whether it was Facebook, or General Motors, or a utility, every one of those financial reports looked identical. That's what's in the best interest of readers. Standardization of information is what makes it easier to be a good investor. If I invested in 15 startups and they're all doing their own sort of communication, that'd be noise. It'd be brain damage. You wouldn't read any of them. How do you pick which one's got better information? You don't know. That's what we're doing. This is my shameless commercial. But it's all based on experience, folks. I was a portfolio manager, a securities analyst in the public markets, and I managed people's money, and I was a philanthropy consultant. I know how they want to be communicated to. If you do it wrong, it's your own damn fault. You're making the entrepreneurial journey harder than it needs to be. And I pity your friends and family that supported you. Because you're making a choice that's an arrogant choice. It's a selfish choice based on your own insecurity, fear of how somebody might react. That's all the wrong reasons. Because the number one reason startups fail is timing. And none of us can predict whether it's good timing or not. I don't care who you are. The most experienced VCs will tell you, we got lucky. They didn't see it coming. They got lucky. They'll admit it. They're confident enough to admit that. Everybody else, all these other newbie VCs, think they know what a good deal looks like. And we know what the right due diligence questions are. It's horseshit. They're too insecure themselves to admit luck and timing is principally what's going to drive whether they're viewed as very good or not. So as entrepreneurs, you don't know whether your time is going to be good. You want to improve your odds of success to stay around a long time, right? To not leave a bunch of pissed off investors in your wake as you're raising yet your next round. You want to treat them with respect because as the Y Combinator, there's another chart I took off of here that I've done in presentations in the past is, if you want access to those same investors, I've got an investor on my cap table on Angel Span, who was an investor in my previous attempt at solving this problem 17 years ago. He lost all of his money in that prior company called Angel Legacy. And yet he came back and was the first investor in Angel Span. Timing was bad. I did all the right things. It still didn't work. For a whole myriad of reasons. Some of which was my fault, some of which was bad timing. He still came back and invested. This one's on my board of directors today. So if you want to be a legitimate entrepreneur, a serial entrepreneur, you damn well better treat your current audience well, because you don't know what the outcome is going to be in your company. You're going to fight the good fight, communicate like hell, find creative ways to raise money, de-risk it for your investors, and there's still a lot of uncertainty. You want to go back to them and say, look, we fought that fight and our timing was bad. We got another way. It got cheaper. It got easier. There's some new information. Whatever reason, you're still passionate about the problem, like I am, and you chose to come take another run at it. You may find you get a lot of support quickly. Okay, if you treated them right. If not, good luck with it. That's my lecture, folks. I'm tired of it. But it really is. Entrepreneurs are heroes. You really are heroes. What you guys are doing is hard. I'm an entrepreneur. It's freaking hard. It's lonely. It's difficult. You're thirsty for somebody to offer you unsolicited, well-intended advice and support. When it happens, you just want to give them a big hug and a kiss. Right? It's hard. Entrepreneurs are heroes. Those investors that are willing to support you for the right reasons are also heroes. Don't disrespect them. Treat them like heroes, just like you want to be treated. Because the magic that happens from that is phenomenal.
Hey Joe, have they finalized the relationship between Mass Challenge and Angels Fan? I know that was still hanging out there.
Yeah, you guys should have gotten an email this morning. Yesterday?
Was that the Mike Millard one? I
Yeah.
it was over late, so.
Yeah, we've been trying to get our service free for you for the entire tenure here. Mike and I have been pitching corporate sponsors. We haven't secured one yet. You guys are getting far enough in. We've extended a free month service to get you guys started. We're trying to get you
But
guys
you're still
to
going to
do
work on it on that.
Huh?
So that's to get us going, but you're still working on.
Oh, absolutely. If we secure a transparency sponsor, then it'll all be paid for.
Okay.
But sitting there and waiting, because it's not expensive, folks. I promise you that. I've had people say that's all this costs. The time we save, the bandwidth, the mental bandwidth we free up, your time should be worth more than what you're doing. It's $250 a month for the monthly updates and the other things we do. Once you raise money, then quarterly reports, that's $600 a month. But that's after you've raised enough money. You've got enough outside non-friends and family investors. But we do all the curation, we do the writing, we do a lot of coaching on how to creatively find and message to these investors. If you don't get it, I don't want you. If you do get it, it's cheap.
Yeah, my main concern is setting up the promise and not continuing. So I want to make sure.
Ours is like crack, baby. Once you get started, you can't go backwards. It's called signaling theory. And that's a fact. It is like crack. If you stop these investors and stakeholders, because our monthly updates are built to go out to the widest audience of stakeholders, potential investors, existing investors if you've got them, and other stakeholders that can help you be successful. Like the mentors here. They may never be investors, but you don't know who they know. And if they're watching you and you're still respecting them and value their input and executing on the advice they gave you, they got a dog in your fight now. They're going to want to make sure you're successful. I've got one of our clients that her investors, who she wasn't communicating to, forced her to use Angel Spanish. She did it kicking and screaming. It's a technology company. And when she finally signed up, we got our first monthly update out. A stakeholder, not potential investor, but a stakeholder broadly defined, sent her monthly update, her first one, to these investors. They wired in $200,000. She called me breathless. It worked, you're right, it worked. No shit, right? It's true, you don't know who they know. And if you treat them properly, you're going to make them look good by sharing your work with somebody else. I always tell people, say, what's a stakeholder? I said, if your neighbor has asked you 3 times, how's your company doing? They're watching for reasons other than just being neighborly. They may know somebody who can help you, but they're keeping an eye on you. So if your neighbor asks 3 times, the 3rd time you say, hey, we've got this monthly update. Would you like to be on it? Everybody says yes. Everybody says yes. And then they've got something to forward to somebody else. That's what we unlock, is an advocacy from sources you don't even know about, because we're making sure you do it right, making you stand out, making you look good, and making them look good for caring about your cause, and you're such a responsible entrepreneur in how you communicate. That's the equation we unlock. It happens all the time. We got a lot of customers. One of your colleagues, Doug Quitmeyer, year 6, he sent me an email this morning on, I coached him on this foundation, I'll read you the, I'll put it up here. I coached him on how to find a charitable pile of money, just like what we just went through. What's he said here? And he asked him, can I send his email? You see what we're doing? He sent him his monthly update. This shit works. Okay? You can't call them, you can't send a personal email, you can't send a newsletter. It has to be done in a way that's professional, because that is the brand you're sticking out there. And if you want to mobilize champions, you've got to do it in a way that makes them look good for championing your cause. You got to stand out amongst all the other entrepreneurs knocking their doors. So anyway, this stuff works. So anyway, I'll stop lecturing, but I just want to grab entrepreneurs and go, Jesus Christ, don't you know? I'm really bad at that. I'll just open up broadly to find it. Open up for any questions.
I got a tactical question. You said search Crunchbase. I'm new to Crunchbase. I just
Okay.
pulled it up. I've been on it once or twice.
Okay.
Like, how do I find what I actually need on here? It's pretty massive. So if I'm looking for a group that has recently had this exit for that tax implication that you talked about, the second one that you referred to,
Do they not teach you guys how to do research here? Is that any sort of... God.
well, not on this particular database. So I just want to make sure I'm using it right.
Yeah, the exercise I take every entrepreneur through, and it's really revealing and figuring this shit out, is I ask every entrepreneur, who cares if you're successful? Who cares? It's not as obvious as you think. Well, I care. My shareholders, not a wrong answer. That's an internal looking. Who externally? Well, everybody that wants. Well, everybody's too big. People that want. What kind of people? Who's your buyer? What's going to motivate them to write the check that they can't otherwise get in the marketplace today? Okay? So once you message that, let's do this exercise. What's your business?
I'm with Matt Shelton.
Oh, I'm sorry. Epilepsy. What are you doing?
Advanced scanners. We make a scanner to improve brain surgery.
Okay, so who cares if you're successful?
Surgeons, patients, hospitals.
That. What?
They care. Ask the question.
Surgeons, patients, and hospitals. That what? What can't they get in the marketplace today that you provide? That want what?
They want better outcomes for their patients by reducing the amount of brain tissue excised, so we give them a more precise surgical navigation to do that.
For epilepsy patients.
For anybody getting open brain surgery, epilepsy, cancer,
There
we're
we
focused
go.
on
Okay.
epilepsy.
There we go. Okay. So, Brain Institute. Where do you go find people that care about better outcomes for brain surgery? That's not that hard. That's where you start. Okay? They're already writing checks because they care about better outcomes from brain surgery.
Yeah, I get that one. It's the one where, hey, they got 60 days to go. How do I find? What I would love to see is see that list and see an overlap between
Right.
surgeon or doctor investors.
Okay. Have you done any competitive analysis in your industry?
Yes.
Okay. Has there been companies that have come and gone or been bought by other larger companies?
Yes.
Go find those
Some.
companies that got bought. There you go.
You can look at their investor list.
But I'm trying to find that specific delta on the 60 days thing. You said that I should be able to look to see who's exited, who would be in my target.
Well,
Or how do I get
I
that Venn
understand.
diagram right?
I understand.
Because I can just Google search what you're talking about or do some other searches. That's easy.
Right.
It sounds like you had a very specific prescribed way of getting to these guys.
Yes, I track this
only
every
have
day,
60 days.
right? I track it every day. You're not gonna do what I do. You're building your business. This is part of my business, okay? So you're not gonna be able to do that every day. Take too much of your time, distract you too much. But if you unpack where the transactions have happened in the past, okay? People that have made money from an exit from a company in the periphery of similar to what you're doing. That's probably not their only time they've invested in a company like that, especially if they're a VC, okay? You don't know what else they've invested in already where there may be a pending transaction. Or you can go talk to them and they could regret not knowing about the tax laws, and that alone, and you're still fall in their wheelhouse where they've already written checks and made money.
Okay. I get what you're saying.
So again, you can unpack it. You might be able to find these timely ones. Frankly, right now, there's very few that do 1045 exchanges. I had one of my earliest beta clients actually told me he got overfunded in his A round because they were doing a 1045 exchange. One of my existing clients, Lung Therapeutics here in town, he got overfunded from a group out of Dallas that does healthcare investing because they got an exit in a portfolio company and they had 60 days. Okay? He got an easy close for that exact reason. So it's out there. They may be just a med tech VC with a lot of LPs that are taxable investors. They don't have
So
to
if
be
they have a
cancer.
large portfolio, your odds are better, and I got you. Okay, that makes sense.
Yeah, yeah.
Do you have a comment on CB Insights versus PitchBook versus Crunchbase for doing the research?
I look at them all. I tend to stick to one. Crunchbase
Right,
is
they
easiest.
mostly overlap.
Well, they all kind of coming at different things and offer different value propositions. I mean, CB Insights is a bit more macro. Crunchbase is a bit more transactional stuff,
Okay.
more detailed stuff. You can quickly get in the weeds on who the folks are. CB Insights is a bit more macro, top-downy sort of stuff, so it just kind of depends. PitchBook is brain damage,
Okay.
and it's too expensive, to get access to where you can get detailed information. It's just overkill. I've talked to the folks at Bloomberg because they're trying to figure out how to get better data in the private space, and they don't like any of them because they're all principally noise. If you understand the psychology of data, information, insights, actionable insights. Everybody says, I want more data. Well, more data doesn't lead to better decisions. Doesn't lead to better. People want more data because they're insecure about knowing what's the right data. Because right data gives you information. Experience with the right information gives you insights. And then once you understand how to find insights, then time creates actionable insights. Because that's situational based on what's going on right then. But you still have to have insights in your back pocket first for them to be actionable insights. Because that's very much based on time windows. Well, more data. Malcolm Gladwell wrote a great book called Blink. If you haven't read it, you should. All you need is the right 4 pieces of information that you have efficient access to make consistent, good decisions. More data doesn't lead to better outcomes. And that's what principally most of those are, is more data.
Okay.
That's we want more data. So what?
Who cares?
People that are willing to pay use somebody else's money, generally their employer's money, to give them the security blanket of more data, which gives them basic plausible deniability when it didn't turn out, which is typically what happens. This is something I experienced in the public markets for 20 plus years. Wall Street analysts want more data, yet I was able to outperform them consistently with Goldman Sachs and Sanford Bernstein, all these guys, because they got bogged down in more data. I got the right data. It would make a lot of consistent decisions. That's better for average. It's Moneyball. There's no accident that Moneyball works, because you have to be confident enough to make decisions and confident in the information you have that you're supposed to be making decisions on. People that want more data don't have that, by definition. This is fun stuff. What do you do?
Developing a sensor that detects hardness in water.
Hardness in water.
Mm-hmm.
Who cares if you're successful?
Who cares if I'm successful? We're business to business, so companies that build, install, and maintain softeners and water treatment systems and their end users,
Who's going to pay for your service?
the businesses. So right now we're going to
What
be
business? I don't care the details. What businesses?
water treatment companies.
There we go. Water treatment companies that want to save money by or make more money by. Which one of those is it? Is it cost savings or higher revenue?
Depends on how they use this system. So we've been doing
So
research.
don't
on
give me details.
Okay,
This is the tough love coaching.
I know.
Okay? Don't give me details. You got to get this done. Water treatment facilities that want both more revenue, larger markets, and to serve their existing customers better on a cost-effective basis.
Yes.
It's the benefit statement to them. Why do they care if you're successful? Because they need that. There you go. So that's what pays. You always have to link the value proposition, who's going to buy your product or service.
Right,
Pure and simple.
right. But there's 2 kinds of buyers is what I tried to say.
I understand. You can message both of them very efficiently because you message them not in describing the situation, but what's the benefit you deliver to those situations. That want what? They want more revenue or better profit margins. That's how, and it's really important to do that. You have science, depending on the audience, you've got, they call it 30 seconds, right? The elevator pitch. You've got about 30 seconds to get them to want to commit more mental bandwidth to listen further. And it's not how much you can communicate in that 30 seconds, it's the effectiveness of what you communicate. You got to get them to care. Okay? You got to get them to care. Who cares if we're successful? Always think about that. What is that emotional hook? What are you doing?
We recycle food waste from large cafeterias, grocery stores, restaurants, and we bring it to nearby farmers to offset their feed costs. Very simple.
Got it. So yours is community's that. Yeah.
We noticed that a lot of the corporate cafeterias really care
Are
about.
you using Reptile?
Yeah.
Yeah. Actually, I had a call with her a while back.
Yeah. So our corporate guys, they just really care more about doing the right thing than what they do.
Yeah, that's pure impact. That's a layup. That's an easy one. That's an easy one.
Well, it took me a long time to get that easy messaging though.
It's even an easy one can be hard
Okay.
because you don't want to be leading with your own emotion. This is really important. You know, this is bad. No, don't tell me what's bad. What we're doing is important to solve because it's good. And that's where a lot of people, even with an impact story, get it wrong because they overplay the emotional hook. You know, one of the things I take our clients through is if you are really deep tech, where it's a real technical solution, I don't want to hear about the tech. I say, who's going to care? And I get them to lean into what's the profile and the emotional journey of the people that need this same gal, this hard-headed gal. I took her through this. It took about an hour, and we did some whiteboarding. I finally got her to get there on her messaging, and I said, all right, are there any headlines in the paper in the last 3 months where if you were in the marketplace, that headline wouldn't have materialized? She goes, yeah. It was when Yahoo's emails got breached. I said, you know who cares if you're successful? The Yahoo shareholders that had to take a discount on selling their shares to Verizon. Who else? She goes, well, the CEO at Target, when they had 40 million credit cards breached. I went, oh, that's CEO's job? Yeah, he cares. And the liability of the board? They care. It is, sometimes it isn't necessarily the person who actually buys your product. You can find that, hers is deep tech, but that shit wouldn't have happened if they were using our service. Wow. Now you're linking it, making it easy for the person to care very quickly, to get your size in the market, and to get what you solve without ever having to get in the weeds. Right? So Flint, right? Do you talk about Flint? Or what other community has had a traumatic experience because of hard water? Or whatever municipality went bankrupt because their sewage system or their water treatment system couldn't keep up with, or whatever the hell it is. There's ways to find messaging that really makes them go, oh, I get it.
I talk about softener bans that happen in Southern California, and I talk about other places around the country where it's happened.
Yeah, that's a great way to do it. And say, look, see that headline? Wouldn't have happened. Oh, okay, I get what you do. I don't need to know how you do it. I get what you do. Now, why your team? Because we lived there, we saw it firsthand, and I was a scientist. And why now? Because it's cheaper to solve these problems because of Internet of Things and technology and blah, blah, blah. Oh, that's how you can do that very quickly. Okay? Sir, what's your name?
I'm Jake Miller.
Jake, great name. What are you doing? What's your company?
Yeah, we connect surgeons to the preoperative data when they're scrubbed and sterile. We got a sterile wireless device that connects them to the data.
And why do they care?
They can't do it right now. They can't get at it. They have hundreds of thousands of dollars of equipment around the room, and it's all static information. They either have to ask someone else to interact with them, or they just...
Why do they want more data?
To make better decisions.
There you go. Their insurance companies probably care.
They do, in an
malpractice.
indirect way.
There you
I
go.
wish it was more direct.
Well, there's or the hospital administration cares.
Yes, the hospital cares.
Doctors are arrogant. They think they know everything anyway, right? They've got information overload. They got too much shit to read. Who really cares about them not fucking up? Right? Link it to that money, that liability.
Somebody did tell me I should talk to the hospital malpractice.
That's who cares more than the doctor, I promise you that.
Yeah.
Because they're still getting paid, whether that outcome is good or bad, they're still getting paid. But who's liable for bad outcomes? Not the doctor.
We've actually been focused more on time savings because it'll take us thousands of cases to prove that we're reducing accidents.
outcomes.
Yeah.
So the principal value proposition is time savings.
Time savings.
So the doctor can
For
do
the
more.
hospital who's the purchaser, to the surgeon's the user.
So they can do more surgeries, they can generate more revenue.
Correct.
There you go. That's who cares. The CFO of the hospital. Because this allows the surgeons to operate more efficiently, which means more surgeries can be conducted. Because they're probably going to buy your service. The CFO writes the check anyway. of the hospital. So they care because it's gonna help their top line by freeing up the surgeon's time, by making more throughput. It's productivity gain for the hospital, more revenue. It may be that simple a sale. Can't be all this warm fuzzy stuff. It may be as hard, cold as the fact is more surgeries can be done, period. Because that's who's gonna write, if that's who pays for your service, the hospital groups, then that's what's in it for them.
One thing we're looking at, and I'm glad you mentioned the foundation piece, because it was mentioned to me that there's whole foundations now dedicated to reducing physician burnout. We believe our tool will.
Perfect example, another great example of why, who's gonna care? Oh my God, physician burnout. You know, there's these remote communities, they can't keep a doctor there, or fill in the blank, right? I mean, that's a great hook. Sure, well, how are you gonna solve that? Because they've got information overload. We make sure the right information is available to them efficiently. How doesn't matter. You don't need to get in the weeds. How? Well, technology, it's easy. We're just solving for that unique application of the technology to solve this very critical issue.
Actually, I have a question for you and Jeff. You're looking at the Epilepsy Foundation. Were you looking for an endorsement from those guys as well when you were talking, or were you really just looking at their donor list?
We got our first money from the Epilepsy Foundation, so when I sat down with Joe, we were looking at their donor list, the foundations that were contributing as the same people we should be trying to reach out to.
Because what does every startup need, right? Depending on your startup life cycle, A, you need money, you need referenceable customers to test drive your product, do 1,000 surgery. We go find people who already care about it. There were a lot of doctors on the list, weren't there? So they may be
Doctors,
people that
family
could be
foundations,
buyers
all giving
of-
to the place that
Yeah.
endorsed us.
Yeah, they now got a dog in your fight. They may bring it in and be beta testers. Right? So you can get 2 or 3 things from that list because they show they already care, they got money, and if they got MD behind their name, they might be users of it.
And every foundation has this on the website.
Thank you.
What's your business?
George, we just help farmers make more out of every inch of their farms.
Well done.
Yeah.
Well done. I can figure out that from there. That's not hard. How about you?
Field capable monitoring device.
See, now who cares if you're successful?
Golden Heart families, soldiers, military medicine, EMTs,
That want-
physicians,
that want
insurance
what?
companies.
That want what?
More people to come home alive.
Come home alive,
Yeah.
and they're not now because?
Because they're dying in the field of undiagnosed internal hemorrhage.
Boom, there we go. Got it. Better diagnosis, in the field diagnosis, so that more people come home. Boom. I don't, all that other shit you said first, I have no idea what you said. That I understand.
Yeah.
The how is not relevant. The how is, why now? Because a lot of technology allowed us to do this, solve this problem. It couldn't be solved before, with all those things you said. Because the chips are gotten cheaper, the information flow's gotten better, wireless sensoring, all that's just timing, right? That's all the secret sauce of what you're pulling together. But what you're solving is really what matters. What about you?
We have a tissue engineered nipple for nipple regeneration.
Oh, yeah. What's the name of that?
No epithelium.
Yeah. Who's the gal that's been running it?
Myself and Lauren.
Lauren.
Yeah.
Lauren's one I know. Bumped into. How about you?
I'm actually a finance student. I'm just here to learn.
I'm sorry?
I'm actually a finance student. I'm just interning here, but I'm just here to learn.
Oh, good answer. Well, there you go. How about you, sir?
I'm doing online shipping. We're helping online sellers to find a better shipping service,
Yeah.
so they can keep their costs competitive and
Yep.
more efficient.
Why is yours better than Ship that just went out of business?
Ship is actually they're running their own fleet. For us, we're doing price comparisons and booking services.
Yeah.
So we don't run our own fleet.
Okay. Do you know ShipHawk out of California?
Yeah. So we are direct competitor with them.
Got it. That was that client of mine that was in my beta customer that got an oversubscribed funding round because of the 1045 exchange with ShipHawk.
Yes, correct.
Yeah, that's who it was. So you're doing what ShipHawk does.
Yeah.
Why is yours better or different?
We have more international presence.
Perfect.
Yeah, we have
Good enough.
language and all this.
Perfect. Yeah, got it.
We're talking about foundations. Will foundations share their donor list? Is that what you were saying?
It's published on their website. They have in their
Like
annual
a
reports.
Wounded Warrior Foundation or something?
Yeah, if you go to their annual reports, it's all in there. They're required to, right?
Above
They're
a certain
required to
amount.
share.
Yeah, they have to file a 990 tax return, and they typically, in their annual report, will list their major donors to give them recognition and credit.
And major is above a certain amount.
Well, they'll list it, oftentimes, depending on what major, it could be up there, 500 above, 10,000 above, 1,000, they'll grade, they'll look gradations. Yeah. And they'll list who it is, it's a family foundation, if it's an individual. I mean, I'm a finance nerd, right? I studied quarterly and annual reports in college to pattern fit, to find people that are on multiple boards. Learning how to read an annual report is really fun. A lot can get revealed. I'm dead serious. Kernels of information that's really valuable, isn't it?
Yeah, we've looked at those to find out what other technologies our potential acquirers have been investing in, what doctors they're working with, what hospitals, they'll talk about research they're funding.
Yeah.
Water treatment is almost all private. There's very little public investors.
Yeah,
So
that's probably true. It's probably industrial folks.
$5,000, $10,000 reports, and you have no idea if they're good.
Yeah. I'll bet you I could find a lot more research than you
I
realize.
bet you could.
I'm a frustrated librarian. I like research. I freaking love research. It's so fun. But it's important for your businesses because I help kids coming out of college get jobs. And I tell them the same thing I tell entrepreneurs. Go do your homework. Just do your homework because you don't need to worry about what the interview questions are going to be or the investor questions are going to be. If you walk in and say, this is what we sell. Yes, sir.
Can I reverse the questioning to you?
Sure.
So if I go, Joe, what is it that you do?
Well, who cares if we're successful?
Yeah?
Entrepreneurs that want more efficient access to the resources they need to be successful, and those people that want to provide it.
How are you different than Founder Suite?
We do, well, a whole myriad of ways.
Okay.
Our only competition is do-it-yourself tools,
Okay.
period. Founder Suite's a do-it-yourself tool, okay? But so is MailChimp, so is Gmail, so is Visible, so is AngelLoop, so is Startup 360, I think is their name, Reportly. They're all the same, they're all dashboards. Now, that survey that we ran, all of those have been in the marketplace plenty long, and those entrepreneurs are still not using it. Why is that? Because they're do-it-yourself. Entrepreneurs don't have enough time, they don't have enough money. We solve for the time, and we facilitate access to money. Because of our curation, our expertise, there's lots of other things that we also do that's well and goes above and beyond what none of those even talk about. Because they don't have the ability to, because they're all built by technologists, not by somebody that was a money manager, an active angel investor, philanthropy consultant that also advised angel investors. So the domain expertise that also informs our solution that makes it different, not just how we do it, but some of the other qualitative things. So, good question. Yeah. We're, as a shameless plug, what our vision is, solve the information gap so you can solve the funding gap. That's my goal. It's not about selling investor relations to startups. I want to accumulate a database of startups because when you guys give us the information, we make you look good. There's also structure behind what we're reporting on that's informed by what's called the Bell Mason diagnostic. That allows us to have a structured view on how well you're executing. And that's part of our service. We give that back to you. We're not hiding anything. But our database will be the first database of objective, real-time operating performance on startups, just like I had in the public markets. We're getting ready to release the next iteration of Angel Span's vision, which is we're launching the first national network of venture capital funds, called the Legacy Funds, to mobilize family office money and foundation money, utilizing these tax laws, into the startup ecosystem. We're going to make it easy for entrepreneurs using Angel Span to have access to those investors by emphasizing all of these instruments I just educated on. So, watch for the Legacy Funds. I think we're done. Hope this was worth your time. Thank you very much.
Thank you.